And that was a little bit earlier than I really intended to get into those type of patterns and setups because they're a little bit more complex, but that's what the market is providing for us. So I thought it'd be good to go in and look at the last 4 or 5 trades and see what's happening with those trades. And in doing so, I think I'm going to be able to flesh out a lot of things, including money management, the trading psychology, and then, of course, the methodology itself. And as time allows, we'll get into the mystery chart. There's not a whole lot to talk about there. So if we don't get around to that, it's no big deal. Then, of course, Q&A. Feel free to ask questions. This is your show, as I discussed last week. Obviously, I want to thank everybody for coming today. I appreciate you taking time out of your busy schedule to be here, and I'm humbled by your presence. There's a disclaimer screen. As you know, you can lose money trading, or as I often sum it up from my friend Greg Morris, all predictions about the future, and a lot of stuff can happen between now and then. So let's talk about the methodology in action. Now, one thing I was thinking about before I went live is I don't want to show you a bunch of things in hindsight, or I want to at least show you that everything I talk about is something that I've mentioned recently. So I'm going to go through every recent trade that I mentioned over the last month or so in my trading service. And then I'm going to also add in 1 or 2 trades that I've recently done. But these were mentioned in the Facebook group. So everything here, again, is mentioned ahead of time. So this is not in hindsight. And as you'll see, as some of them aren't working out in a fantastic manner, that you'll say, well, okay, well, he didn't pick just the best ones to show us. Anyway, with that said, AUY, this is a gold stock. And this is a pattern I call a TKO. And I'll be covering trend knockouts or TKOs in upcoming shows. And hopefully I'll get to that sooner rather than later. So keep an eye out over the next few weeks, and I'll be happy to cover that pattern. Looking forward to it. But basically what we're looking for is a really strong trend in a stock or other market, and you're looking for a knockout type of move, a wide range bar down. And the idea is that it knocks out some nervous longs and attracts some eager shorts. If you go back to the first show when I talked about my ground rules, I discussed the fact that there's a psychology behind every pattern that I use. Everything is conceptually correct based on the behavior of the market's participants. And we're looking to, in this particular case, take advantage of their predicament, meaning that the longs have been knocked out of the market and they may be forced to put up or shut up when the market begins to rally. And the shorts, on the flip side, are trapped in the market and they may be forced to cover, and that could help propel the stock higher. Now, without getting into the entire pattern, that's pretty much it in a nutshell. We'll cover this in future shows. Here was a setup. If you look down here, the entry was 350. The protective stop was 280, and the initial profit target was 420. So we're looking to buy here. Our stop is here. And then the IPT is off the charts at 420. Now let's take a look at what happened. So you could see that although we initially had some nice movement in our favor, the stock, for the most part, has spent its time underwater. So we had very little time up here where we were in the plus column. And then most of the time is spent down here in the minus column. You're probably thinking, well, Dave, why don't we just get out of this? Because it looks like it's dead money. Well, I often do a dead money report where I show stocks that go sideways for quite a while after we get in, and then they take off. But a lot of people will give up. Remember, the market's job is to do what it has to do to frustrate the most people and also to cause the most amount of pain to the most amount of people. So far, this one obviously hasn't worked out, but we're just going to hang on to it. Now, this is a gold stock, and not that I try to confuse the issue with facts. In fact, I actually own the domain, don't confuse the issue with facts. But I'm not too nervous about holding a gold stock in this day and age where 140 characters could easily push this stock much higher. Now, as I just said, with that last trade, we sat in it and it didn't, so far it hasn't done anything. And we might get stopped out. If it happens, so be it. And if truth be told, I'll probably drop an F-bomb when it occurs, but then I will shout next and go on to the next trade. Now, here is another first thrust setup. We talked about this one last week, or I'm sorry, we talked about the first thrust pattern last week. And what we're looking for is a sharp sell-off from highs and then a bit of a pullback. Now, in this particular case, it was a bit of a kind of a micro first thrust because it wasn't a huge move down, but it was a fairly sizable move. And it looks like this stock could be in trouble. Now, here's the actual setup. If you look towards the bottom of your screen, you'll see the entry was 44.50, stop at 52.50, and initial profit target of 36.50. So that's 8 points we were looking for the initial profit target and for the stop. So this is what it looks like on the chart. The entry is here. The protective stop is up here. And then the initial profit target is here. Now, as I said earlier, I kind of want to sneak in a little bit of the money management psychology of all this. And it's hard to sit there and watch a stock just kind of grind sideways after you get in. After all, we're supposed to be trend followers, and where's the trim? But I found over the years it's much easier to just follow the plan. If you get stopped out at a place where you're obviously wrong, then you just get out of the way. But it is tough watching a stock day after day after day, especially if it's going against you. But in this particular case, you can see it just kind of meandered in here. And I think we only had one day where the stock was in positive territory. And it's very hard. This is 2.5 weeks of trading, maybe a little bit more. And it's hard to just sit there day after day after day watching this loss. But then look what happens. This stock implodes yesterday, goes down to tag the initial profit target. And the way the money management works is we sell half of the position. And again, if you don't get the money management, don't worry about it. You can get a free copy of my book. I'll give you that link again at the end of this presentation. And also in upcoming shows, I'm going to talk a lot about money management. As I often say, one day I'm going to do a complete course just on money management, and probably 2 people will buy it, but that's okay. Those 2 people at the least will get it. And as I often also say is a lot of times I'll do a seminar or a presentation in person, that is. And after the show, a bunch of people will come up to the stage and ask a bunch of questions, and 99% of them are asking questions about the methodology. And I have 1 or 2 people who ask a question about the money management. And I know that those 2 people get it, or either they're already successful or they're close to being successful because they're more concerned about the money management than they are the setup in and of itself. Now, setups are important, don't get me wrong, but the money management is also crucial. So the idea is to capture a swing trade on these setups. And I'm slotted as a swing trader, but I will hold a position as long as it moves in my favor. But the real money is in the second part of the trade, where you're holding half of those shares. You sell half for a swing trade, just in case that's all you get. And in the next example, I'm going to show you where that happened exactly. But you hold on to a piece in case the market continues to take off. Now, in this particular case, once we hit that initial profit target, we move our stop down to break even. And now the worst thing that can happen to us, barring overnight gaps, of course, would be to break even on the remainder of the trade. So now you're sort of playing with the market's money, so to speak. And it's not the greatest way of describing that, because I know that it has a little bit of a gambling annotation to it, or connotation to it, I should say. But it is a great place to be from a psychological standpoint. People often ask me, Dave, is your money management, is that psychological or is that statistical? And my answer is yes, it's statistical in that you often only get that swing trade out of the position. But it's psychological in that, one, you are, and I don't want to go all freshman psychology on you, but you are sort of filling those Maslow's hierarchy of needs by, number one, getting that instant gratification. We live in this microwave society where everybody's expecting all this instant gratification, and it's tough. It's cell phones, microwaves, the whole 9 yards, everything is instant. There's no video stores anymore. Why? Well, people won't get in the car and drive to a video store. Everything is instantaneous. And I think we expect our trading to be like that too. So the good thing about the money management is by taking that swing trade profit, we're able to get that piece off, that quick little reward, but then we're able to get that more fulfilling longer term move on occasion. It doesn't happen that often, but often enough to make it all worthwhile. When you capture that longer term trend, all you need is a few of those a year to really make your year.
Dave?
Yeah.
We have a question in the room
Sure.
about the PAGS chart.
Sure.
He says, do you set the targets based on a measured move?
No, it's not a measured move, but a lot of times, a lot of technicals will come together at the same point. What I'm looking at is the volatility of the stock. So in this particular case, the 8 points was if it went back towards those old highs or near those old highs, I knew that I was wrong in the trade and I would have to get out. So the stop is based on the volatility of the stock and then also where I would be wrong. And I promise I'll do a whole show just on setting stops. And this gentleman or lady, I'm sure, will be one of the few people that'll be there, but I promise I'll do a show just on that. So it's based on the volatility of the stock and how far it can move over a short period of time. So let's take a look at RUHN. Now, last week we talked about bow ties, and a bow tie is just simply 3 moving averages coming together and then beginning to spread out really quickly. And that suggests that the stock or the market, of course, has bottomed out. And then we're looking to get long after a pullback. So here's the actual setup here on the RUHN. Entry of 520, stop of 420. Now that seems a little extreme for a cheap stock, but that's what it called for. So getting back to the prior question, this is a very volatile stock. So you're looking at, I guess it's about a 25% stop, which seems kind of crazy, but that's what it calls for. There was a popular methodology, and I guess it's still a popular methodology that says that you shouldn't risk more than 8% on a trade. Well, that's like saying we should all wear a medium-sized shirt, and that's something that my fat butt hasn't done since I was 5 years old. So you have to make sure you give the stock plenty enough room. This stock here can move 8% in a few minutes, and if you're using a stop within that normal volatility, I can all but guarantee that you're going to get stopped out. Now, in this particular case, this stock was put on this day here after this little bit of a kind of a knockout type of move. And I'm sorry, the setup was put on the trading service on this particular day. And then 1, 2, 3, 4, 5, 6, 7, 8, almost 2 weeks of trading, and it didn't trigger. And I nearly gave up on this, and I almost forgot to put the order in, but luckily I remembered. And that's the other thing about markets is, as I said earlier, they'll often do what they have to do to frustrate the most. But luckily, I did remember to put the order in. I think one of my clients nudged me on that, which I want to thank him for. So that's where our stop would be, about a point away, or exactly a point away from the entry. And then we were very fortunate. The same day it triggered, it ran up and hit the initial profit target. It actually rallied 60% in one day. Now, I feel like I should be like the diet industry. Results not typical. We don't often have a stock rally 60% in one day, but it can happen. And in this particular case, what happened was once you hit that initial profit target, you bring your stop up to break even. In this case, because it was such a big move, we brought it a little bit further up than break even. And then the stock came down and sold off and stopped out. Now, what's interesting in this particular case, and this is a testament for why money management is so crucial. Notice that without any money management whatsoever, this fantastic shorter-term trade, not the best trade in the world, but a decent short-term trade, would have turned into a losing trade without money management. So I can't emphasize the importance of money management enough.
Dave?
Okay, we're going to take, yeah, go ahead.
Oh, we have another question from Stephanie.
Okay.
And it's, yes, do you ever use options to either augment or replace the stop trade types, sells, stops, limits, etc.?
Yeah, absolutely. Not so much as like a hedge, but as you'll see in a couple examples, I actually did buy puts as a substitution for stock. And when we get to, I'm glad she asked that, because when we get to that example, I'll walk through how that was done. But another thing that I will occasionally do is if I take on a short position and I have a lot of profits in that short position, I know that the chance of a retrace rally is pretty good. So what I might do on some occasions is I'll trade out of that short position and then fritter away a portion of the proceeds from those profits on options, because I know that I'm probably going to have a retrace rally where I'm going to lose that amount of money anyway. So I'll roll it into an options position. Okay, before we get to this next chart, let me take a time out for a quick commercial. We're back. Let's take a look at another trade. Now, notice what's kind of fascinating is we had two long trades, one gold, which hasn't worked out just yet. And gold, as you know, could trade contra to the overall market. And the other thing is the database has been providing us with an overwhelming number of shorts. And by the database, I just mean me looking at a tremendous amount of stocks every day for opportunities. And lately, I can't find a long to save my life, but I'm still seeing a plethora of shorts out there. And that's why you're seeing so many shorts mentioned. Now, shorting is a little tricky. If I never had to short another stock in my life, I would be fine. But it's the only way to make money when the market goes down. It's the only way to make money when that's all the market offers you. And the advantage of shorting, or the biggest advantage, I would say, because you're not really going to get rich on the short side, but the biggest advantage is that it helps you to see both sides of the market. I know I've said this ad nauseum, but I'll say it again. My friends who run hundreds of millions of dollars who are long only oriented, nothing wrong with that. That's part of their charter. But they tend to always see the market as glass half full and not glass half empty when it begins to get a little iffy in here. And most of the time they're right, because obviously the market does tend to go up most of the time. But the great thing, again, about the short side is it does help you see both sides of the market. So tractor supply in here, you can see we had a nice thrust lower, and this is what I would call a first thrust, or if you prefer, just kind of a generic pullback, because it sold off hard from its highs, begins to pull back a little bit, and here's our setup here. So in this particular case, we were using 10 points as a stop based on the volatility of this stock. So it gives us a nice round number of 100 for an entry, 110 for the stop, and 90 for the initial profit target. So here's the entry here at 100. The stop is up here. Our initial profit target is down here. And notice, as soon as it triggers, we're immediately at a loss for over a week. Now, this is tough. And I want to let you people know that I have a pulse too. Just because you become a trader doesn't mean that you don't still have a pulse, and you won't get emotional and frustrated. And it's kind of hard to watch this stock go against you day after day after day. But you have to plan the trade. I know it's cliche, and then trade that plan. So obviously you're bummed out for about a week in here, and then look what happens. And again, what did I say earlier? The market will do what it has to do to frustrate the most, or cause the most pain in the most amount of people, or trick the most amount of people. And I've gotten all those adages from Linda Raskey, just to give her credit. And I asked her where she got them from, and she said, "Oh, I don't know, probably from the floor." She didn't even remember saying it. She's so humble. But anyway, so this is how it shook out, and you could see that we did achieve that initial profit target, and we trailed the stop lower down to the entry in this particular case. Now, if this stock continued to drop, we would continue to trail that stop lower. Now, the secret sauce is that in order to help ride out a longer term trend, we adjust to the longer term volatility of the market by gradually opening up that protective stop. And that's often by not doing anything. And if you look at the bottom of the chart down here, and let's see if we can get the thing to work. You can see down here, we actually had more than 10 points profit, but we left the stop where it is. So thereby it widens out a little bit by 1 point in this particular case. And that allows us to hopefully, I know I should never use the word hope, but hopefully ride out a longer term trend. Okay, let's take a look at plan. This was another one of our short trades. Now, again, everything I show you, I want to make sure that I actually mentioned it publicly somewhere. either in my trading service or in the Facebook group. But you can see this particular case here. We had a bow tie, as we discussed last week, and then we had a sell short based on that bow tie. Now, I actually mentioned it after it pulled back. I was just asked about puts. So what I did in this particular case was I ended up buying in the money puts as opposed to outright short. Okay, any questions on any of the walkthroughs before we get to the mystery chart, or any other questions for that matter?
Not right now, but I encourage everybody, if you have one for Dave, write in.
All right, fantastic. Okay, so we didn't have time last week to talk about the mystery chart, but I wanted to bring it up again this week. Now, this is a live potential trade, and today or tomorrow might be the last day that I show it as a potential trade. But you can see here's a stock that recently made brand new highs, and then it began to sell off fairly hard. Now, if you go back 2 weeks, you'll notice that I talked about the net price movement. So if you didn't know anything about technical analysis, you just look at where a market is, and then you go back in time and look at where it was. So in this particular case, this stock dropped from the 90s down into the 70s fairly quickly. And based on the volatility of this stock, that's a pretty sizable move. And then you can see that it begins to pull back. So we're looking to short this stock at 71. And then if it triggers, and I forget exactly where the stop is because I don't have the spreadsheet in front of me, but it's probably up here about 10 points away and maybe a little bit more, which will give us a target down here in the 60s on that one. So as you can see, money management is very crucial in all of these trades. And it's also very important that you have the proper mentality when it comes to taking these trades and following the plan. And trust me, it's hard to sit there for days and days and days when a market is going against you. But as long as you're not stopped out, you must continue to follow the plan. Let's take a look. Why don't we take a look at the S&P 500 real quick? Okay. Should be seeing the S&P 500 right now. So the main thing you need to look at, sorry about that, the main thing you need to look at is that the net price change. And this is something I talked about quite a bit over the last few weeks. And notice that we haven't gone anywhere on a net basis over the past several months. And then also we have these multiple peaks in here. So this maybe is why we're seeing so many shorts right now. And it's important to look at a lot of charts and listen to what the database is telling you. If you're seeing short after short after short, maybe it's time to put on a short or two. And again, not my favorite thing in the world to do shorting, but you have to play the hand that's dealt. I used to race sailboats years ago, and the sailmaker every now and then would come on the boat, and when it was light air, everybody would complain and moan and groan and move around the boat and get a sandwich or a beer or a Coke, whatever. And it would just stop the boat's motion and everything. We'd get nowhere. The sailmaker would make everybody quiet down, and he would say, if you love light air, it'll love you. And before you knew it, he would get the boat moving. So the same thing kind of goes with the market. If you're willing to just embrace what the market is doing, if you're willing to embrace if it's a downtrend or if you're only seeing short setups, if you love the market, then it'll love you. Often the market is not going to do what you want it to do. And that's where it becomes very difficult for a lot of people. What is. So right now, the S&P, you can see we're stuck in this range. Let's take a look at the bow tie moving averages. And as I've said before, we're going to make sure that we get you guys set up so you'll be able to have these templates that I use. And I don't use that many different things, so I wouldn't get too concerned about it. Most of the time I use a blank chart, and then occasionally I use something like the bow tie moving averages. But as I discussed last week, we had a bow tie back here, and the market didn't sell off much from that. And then we had another one here. Now, moving averages are beginning to cross over once again. So if we come back down below these moving averages, I would be concerned, and I would watch down here around, let's say 28.25 as potential support. So if we take that out, then we could be in quite a bit of trouble. And here's the other thing too, as I've been saying quite a bit, everything I do is based on the psychology of the overall market. So what happens is, if we do drop below this 28.25, everyone who has bought this market anywhere above 28.25 or so is now losing money. So let's see if we get that drawn in on the chart. So let's say 28.25 down here, roundabout. So anybody who bought in this area up here will be losing money. So if we drop below that, this market's going to have a very hard time coming back above that level. So I would pay close attention to 28.50. Now, on the upside, keep in mind that markets are often prone to false breakouts. So we could see the market push towards new highs, but that's not necessarily going to be an all clear if we get there. So if we do get to new highs, that would obviously be a good thing, but wait for follow through. I would be very careful trying to buy that breakout in and of itself. And then again, look at a lot of stocks, see what sectors are going up, see what sectors are going down, see where you're seeing your most amount of setups. Recently, we saw a ton of setups in software, and those have worked out nicely for us. We saw a retail stock or two, as I showed earlier, and then we saw a speculative Chinese stock, which worked until it didn't. And then we also saw a gold stock or two setting up, and those haven't worked out just yet. And you kind of have to just take the good with the bad and let the chips fall where they may. Okay, any other questions coming in?
We have about 40 seconds left. If you could answer this one quickly, if not, we'll get to it next week.
Okay.
And he asked, what time do you typically wait until putting in an order after the open?
Okay, an order might go in as soon as a few seconds after the open, or it could be any time later in the day. But the actual order, because the problem is the market might move right away. And if it moves right away, you could miss a very sizable move very quickly. So very important to get those orders in as quickly as possible. But you do have to watch the open just in case you have like an opening gap reversal or something and you want to avoid getting caught up in that. Okay, I think that's it for today. I want to thank everybody for coming. I appreciate your time, taking your time out of your busy schedule to be here. If you have any unanswered questions, easy for me to say, Landry.com. And if you're interested in my books and other things, you can go to davelandry.com.
This is a brief demo about how to scan for things that made a new high earlier in the week or the month. Rather than using a daily scan, which would say that it didn't make a new high today, by using a monthly scan, it'll get anything that was above this previous time period. So to do that, we go into technical scans and we create this month's high is greater than last month's maximum over the previous 12 months. I've also set it up with a close greater than $5. But when we run that scan, obviously it brings us our data, and what we can do is we can sort it into industry and sector, and Buckle was the current stock that I had up there. But look at how many apparel retailers are also hitting new highs in this current month. So this would lead you to believe that there's some strength in that sector.